Hello everyone, Namaskar, good evening. Uh, Today we are here to discuss one of the very important topic, how we can control the frauds or how we can utilize the management accounting tool as a prevention or as a prevention measure or a control measure for frauds. So we have very wonderful speaker today, Pradeep Ji, and for the special address, we have S. Raviji, very eminent speaker and eminent industry. He has very wonderful experience of the industry. He has been the board of so many institutions. So we have Yogesh Agarwal ji also, who is the vice chairman of Aurangabad branch of WIRC. So welcome you all on today's virtual meeting on management, virtual meeting by the management accounting committee. And today we are here to discuss how management accounting tool can be useful for the prevention and control of frauds. So for the welcome of our guest, I would like to invite Yogesh Agarwal ji to welcome our guest speaker Godbole ji and a special address Sri S. Ravi ji.
Thank you, Andre ji. Good evening. Today's guest CA S. Ravi sir and speaker Pradeep Ji Godbole. And today's topic is management accounting as a tool for prevention and control of frauds organized by Committee of Management Accounting, headed by our beloved Chartered Accountant, Central Council member CA Charanjot Singh Nanda sir. We are little bit unfortunate today that we could not hear him, because he is the person who can drive any event single-handedly. So Charan sir, we will really missing you. So with this short I request Anirudh ji to please continue with the event.
Thank you, Yogesh ji. And now we are excited to hear S. Ravi ji on the today's important topic. So before his address, I would like to take an opportunity to welcome S. Ravi ji with his brief introduction. Welcome, Ravi sir. So Ravi sir is the chairman and director of Tourism Finance Corporation of India. He is also on the board of Aditya Birla Health Insurance Company Limited, Star Union Life Insurance Company, Aditya Birla ARC Limited, IIFL Asset Management Company, and SBI Payment Service Private Limited. He is also a practicing chartered accountant, and he has also served as chairman of BSC Limited and chairman and director of UTI Trustee Company Private Limited. He has served on the board of over 40, more than 40, I would say, prestigious institution, which includes the insurance company, number of public sector banks, public sector enterprises like UCO Bank, Union Bank, Hindustan Aeronautics Limited, BHEL, SBI, and many other institutions. So we are really grateful and we are blessed to have you, Ravi sir, on today's session, and look forward to have a wonderful session and wonderful address by you. Today we will learn a lot on the this management accounting aspects, which can be used as a preventive measure and control for the frauds. So with these words, over to you, Ravi sir.
Namaskar and good evening to everybody. Anirudh, thank you so much for the introduction. Pradeep Ji, my best wishes to you and to Yogesh Ji for being a part of this, and the many participants who are part of this seminar. So to start with, just to give you some stats, frauds in the year 2021, just 1 year, the amount of fraud is 30,000 crores, 36,000 crores approximately. And the previous year, the amount that was detected as fraud was about 63,000. And the companies that were involved in this type of, or declared as a fraud, or there was an investigation going on, was around 1,480 odd companies, which really startles all of us. And that is why today's topic is very relevant. So I personally feel that why this has happened is because we were lax in our system, and because of multiplicity of reasons. And also, let us also understand one more thing, that now multiple regulators are looking into the system. There is MCA, there is SEBI, there is RBI, and even IRDA, so, and PFRDA. So, and every field has multiple regulators. And so even these frauds get easily detected. But today's topic is not about the fraud that has happened, but about stepping back and learning what we can do to prevent these frauds. Now, before we go how to prevent the frauds, let us understand what type of frauds can happen and who can do these frauds. There are employee-driven frauds. You will be surprised to know that about in the manufacturing space, there are 20-25% of employee-driven frauds. Then there is customer-driven fraud. A customer who's doing supply or is dealing with anybody, they do a fraud. And this is approximately 30-35%. Then there are online frauds, which are of course increasing day by day as we are going on to a new generation of business. So online frauds have also increased by about 30-odd%. Then there are frauds done by the management itself, the top management of the company. And that is one sect of people which we never expect them to do a fraud, but they are there. So the frauds are germinating out of multiple reasons and multiple people. And the biggest challenge is today to counter this fraud. And Pradeep Ji will certainly articulate on this, how we are going about it. But as a special address, I would say that these are 4 or 5 components which drive towards a fraud. Now, why do people do fraud? It is out of greed. Person wants to make money. Second, it is because somebody wants to show growth. Third, because somebody has done something wrong in the past and they want to hide it. And why I'm saying this, all these are tools that the basic root cause of all this has to be understood before we go to the tools itself. And so necessity, greed, overstating of growth, and now the biggest challenge is valuation. You want valuation. It's a big game of valuation now. You want to show the company in the best possible light that is possible. And that is there. So these are the factors, the human factors or the psychological factors which drive. Then there is one big thing which, and of course was, we could have seen it in the case of Satyam, was the person goes out of the core business and feels that he can invest in properties and has diverted the money completely lock, stock and barrel and has shown overstated everything, including cash in hand which was not there, cash at the bank which was not there. So all this just because they wanted to go into some other line or go into some other field like the property or disinvesting. So these are multiple reasons which actually are the fundamental reasons for the fraud. So one side, I look at the type of frauds, I look at why the genesis of fraud, and then we look at what types of fraud. Now, what types of fraud? It could be overstating of profit, overstating of debtors, overstating of stocks. It could be also overstating of assets. It could be over invoicing. It could be also overstating the production or understating the production, and understating the production and selling elsewhere. Or it could be also over invoicing of sales, It could be fake sales. It could be anything. So, and it could be a customer who's fake. So the frauds can be multiple types. So these are few of the facts: overstating of debtors, stock, then also fudging the receivables, fudging the book, fudging the inventory, then also looking at showing redundant inventory, or inventory which is slow moving as a fast moving, or the vice versa. So there are many situations which can propel a fraud to be done. And historically, these frauds, whatever happened, it takes 2-3 years to catch up. But now things are very different. As I initially mentioned, it is these multiple regulations which have come in, which also help us in detecting or identifying a fraud faster. But now today's topic is about the management tools. So management tools like cash flow analysis, and for example, a financial statement, financial ratios, and the various ratios that come across with them, and also fundamentally all the statements of accounts which come in actually reflect our tools which can be used for actually finding out the fraud. Budgetary allocation is another very strong tool, though not very easily used, to find out a fraud. So basically, not only find out, but to prevent a fraud. Now, these tools of all the financial statement ratios, how do you use them? But before I tell them how to use them, today there is a very, very strong tool in our hand, which is called the technology. In yesteryears, the technology was not available to detect. Today, any inventory, there is a tagging. You go to any shop in a retailer, you go and pick up goods, there is a tag along with it. And even one walks away, there is a notification to that. So the technology has webbed into the financial management aspect very deeply. So we cannot isolate these two. And anybody who thinks that we have all these financial tools without technology is living in yesteryears. Let me give you an example. In one of the companies, I realized that every year there was 50 crores across about 20-30 different locations. There was about 50 crores of theft. So what we decided very early, we said, let us put web cameras to start. So we could reduce through web cameras, we could find out what it is, and we reduced the amount and we tallied it here. Now, as we progress, there is tagging, there are robotics, and there are tools which are available to us. So the management accounting aspect is very vital, but it has to wed with the technology. Now, budgeting is another aspect that I very strongly feel is a very, very important tool in our hands, which we don't utilize it appropriately. For example, let me tell you, if there is an abnormal sales of more than 40%, the board or the top management will get a statement. And in that statement, it will reflect that we are gone 40% of, so we'll go into the root cause analysis. Once we go into the root cause analysis, we'll find out this sales is genuine or not. So why is the sales can be inflated? Again, I'm coming back to customer, the employee. He gets more incentive out of a higher sales. The management gets higher profit out of that sales. So everybody is looking at their aspect, their very limited aspect. So as a management, oh, I see good sales. Oh, I'm happy because my bottom line, top line, everything will increase. And from a simple salesman or a marketing person, I realize that it is good for me because I may make more incentives. But is it normal? So there are financial tools like you do peer comparison through management accounting system, where you compare it with your peers. What are you better than the peers? Suppose, what is the outstanding feature of yours? So it is the MIS, which is going to ask questions. Okay, you have done 40% extra. You have got 20% extra margin. How come? What it is? So then the questions, if it is, and you can go through the documentation and all that, but the red flag can be raised right at the initial stage when you have an MIS statement. Also, it can so happen that there could be seasonal sales. For example, the winter garments, there is a sales which is very high during the winter period, peak period, or prior to winter, or just about winter is ending, there is a good sales. Now, is the sales higher than last year? Yes, could be. Why is it higher than last year? It could be because this year the winter was severe. So there are many aspects. So what I'm trying to say, information through the management tools, which is just one example that I have given, with an MIS and with root cause analysis, can be a very important aspect of trying to identify and prevent a fraud. Because prevention of fraud is a very big thing. And I will tell you, even Reserve Bank of India came out with a circular for preventing of fraud. What are the steps one must do? Which includes also red flagging. Suppose there is a red flag, on any account. So you have a red flag. You know this is not, it has moved away from normal. So that is what one has to absolutely look at. So from a management tool point of view, again, red flagging from the financial ratios, from the financial statement, cash flow. Why are the expenses high? Why? Is it the employee cost or is it an interest cost? So let me give you one example. So one balance sheet was being analyzed by some good group of directors. They suddenly felt that the interest cost has gone up, but the year-end opening balance and the closing balance was just the same. Has the interest rate gone up? Not really, 0.5% here and there. But then why it happened? Then they realized that they were doing bill discounting at a higher rate to just show that the opening balance and closing balance is low. And the cost of lending or cost of operations had gone up. So they were reluctant to show borrowing throughout the year or the end of the year and the start of the year. So what happens is they discounted their bills at a higher rate outside. So this is one. So once they came to know what should they do, they should call the management. Why are you taking loan at 18%? You should have taken at 9%. So what happens? It's a response of these MIS, which is very important. So my view is these management tools, management accounting tools are very vital. But how do you read it? How do you analyze it? How do you interpret it? And how do you act on it? And what are the corrective steps you take is very important in my view. So tools, just because they are there, they are available to us for from a long time. But how do we use it? Do we use it correctly? Do we interpret it correctly? Do we have the time to actually look at it every time and again? So that is the key thing. So for any management. Let me also give you one example. Some managements have a key people who look at only these management tools. And especially if there is a group of companies, they will see every group of the company and they will compare with last month, last quarter, last week's sales. And you will realize that actually they can check and prevent a fraud. So coming to that, trend analysis within the financial ratios and also of the financial statement can lead to many discoveries. So that's a very strong tool with us, the trends. We don't see trends. We have to be very careful of the trends. Now, let me also take another example. A bottle company which was giving bottles to the soft drink company suddenly saw a spike in the month of December. So normally we see the supplies of the bottle increasing between April, May, June, July, August, and suddenly there was a spike. So they went into that and they realized that this is being oversupplied at a higher rate and and is overbuilt at some place to make money out of it by the employee himself. A very big shoe company, and everybody knows about it, a very big brand, had a big issue about over invoicing, and it was detected in India. I won't like to name it, and then we realized that it was an employee who was very closely doing all this, because for his foreign investor or for his foreign partner, he wanted to show higher sales. The employee, in collaboration with the management of the local place, wanted to show higher sales. So they were in negotiation for a valuation at that point of time. So they showed higher sales. And what happened? The stocks actually were not there. And the investigation happened. And finally, this big brand had to shut down those few operations here, sack the employee, etc., etc. How did that happen? That happened because one smart manager was noticing that the trends had beaten the normal ones. So, considering that, these are the few things that, as a tool, we have very good tools with us. Similarly, on inventory, you have the current ratio, which can look at it. You have the debt service coverage ratio, which can look at the borrowing part of it and the cash flow part of it. So all these ratios and financial statements, cash flow analysis, cash flow sensitivity. Cash flow sensitivity is also another very important thing. Can you match your borrowings and pay back the debt from your cash flow? Can our cash flow take a stress? So if our cash flow has gone into a stressful condition by a stress test, you can make out that this is a problem here. So many tools are available, many methods are available, many you have technology today. We have everything in the palm today. We have every available resource today, and that is why we are seeing that these frauds get detected also. Otherwise, this would have kept on happening. We have sort of with technology, we have been able to do this. Now you see, just to give all of you an example, how many forensic audits are going all across the place. Why? You see, big companies, what happened to them? Why did it happen? And why was the fraud not detected? But the fraud got detected finally. But why did it happen for so long? Because there was a connivance between the top management, employee, customer. And when there is a connivance, it's a very challenging aspect. And the management tool I myself, I'm using the management tool and I am doing the fraud. What can anybody do to that? So now comes the role of auditors and also financial statements, which if there is an emphasis of matter or a qualification that is coming in fresh. So the auditors also, rating agencies also, everybody plays a role. Why has the rating dropped? So we have to go beyond the management accounting tools. These are many derivatives of that. That is what I would like to say. It is a holistic mechanism of preventing frauds. If we are very conversant with financial statements, if we are agile in reading them, and we are prompt in correcting them, it's a very different. You can prevent frauds. And control mechanisms through MIS, various control points, delegation of power. Delegation of power. Have I exceeded my delegation? Have I gone to the board, etc., etc. So I won't take too much of time because we have an excellent speaker. I was told very clearly to restrict myself to 15 minutes. I think I have gone overboard. So I sincerely apologize for that.
Not sir.
But I thought, I was just making up the time for Mr. Nanda and others who did not come in. So I thought I will just step in and at least relieve Pradeep Ji of his long evening that he has got ahead of us. And thank you all for having called me, invited me. I have not made a prepared speech. I just spoke what I felt. Means everybody in this forum knows about management tools. They know about everything, and I'm just sort of just sharing my practical point of view. And last but not the least, technology itself, can you rely on it with online frauds that happen? So my stress on technology should not be it should be taken rightly, but also with a pinch of salt. I think we need to be very careful with technology, because technology can give you a wrong MIS if one wants. So please test it, test everything, and that is what I would say. So thank you so much, and it was nice to spend some time with all of you. A pleasure. And Pradeep Ji, my best wishes for this evening. And thank you, Anirudh, and thank you, Mr. Yogesh. And my best wishes to all of you, all the participants. Have a lovely evening. Thank you.
Thank you, sir. Thank you, sir. Thanks a lot. Thanks for your giving time also, sir.
Thank you so much, Ravi sir. And it was really a great session, and the insight which you have shared with our participant, it was really amazing, because I'm handling the special monitoring assignments, and the insight which you have shared, like the overstatement of profit, data, stock, and asset. And then the way you have said that using the management tool like the trend analysis, cash flow sensitivity, and ratio analysis, all we have seen, and these kind of fraud are actually happening. And we have got so many clients who were actually doing these things, and we have highlighted to the lenders that these are the things, like they are overstating the data and inventory so that they can overutilize the limits beyond the drawing power, which they are actually they should actually use. So yes, we have seen all this, and using the management tool, we can prevent this. So thank you so much for sharing your very great experience with our participants with us. And we are really grateful to you, sir. Thank you so much on behalf of Committee on Management Accounting and all the participants. Thank you so much, Ravi, sir.
Thank you. Namaste.
Now going forward, we have very learned, very experienced personality. Today's eminent speaker, Shri Pradeep Godbole ji. So welcome you, sir. Aapka hardik swagat hai. And before your address, I would like to share a brief introduction about Pradeep ji. So by profession is chartered accountant and having more than 30 years of experience in the banking and financial services. business and technology consulting, auditing, accounting, and management expertise. He has served in the senior management position at reputed organizations like Big Four, Ernst & Young, IT organizations like Oracle, Wipro, bank like Dutch Bank, etc. He has been an independent director of South Indian Bank and chairman of IT Strategy Committee and member of board committee. He has been director of Risk and Compliance Professional Association, a Section 8 non-for-profit company focused on skill and capability building initiative for BFSI industry. He has been consultant and advisor to financial institutions and technology companies in India. So with brief introduction, if I will read full introduction, so it may take half an hour. So without wasting time out there, we are really excited to hear you and look forward to have a great insight with your experience, sir. Over to you, Pradeep, sir.
Thank you, Anirudh. And thanks the committee for giving me this opportunity of sharing my knowledge with all of you. It's been a pleasure, and we heard Raviji, very insightful, crisp thoughts he presented with us. And what I will do is that build upon what he had talked in nutshell, build on that story further. And we will see how those tools and techniques can be used, and some of the stuff which, especially on the technology side, having worked in technology, how we can utilize. I would like to share some thoughts. So I have got a short presentation, and that is based on my experience and also talking to some of the stakeholders. You will have to bear with me since I have worked only majorly in banking and financial services and IT industry. So my examples might be more relating to that, but I will try to make it more broad-based as far as possible. But bear with me if it is more relating to one or two industries, what I talked about. The other thing is that, as Raviji said, management accounting, all of us know, being chartered accountants, and we have studied this, we have gone through all the nitty-gritties of it. So we know everything about management accounting. And so I will not spend time on it. We know it's used for business decision making, but let's see how it can be used for preventing of fraud. So fraud, again, we have studied before, and we know what is fraud, but in a layman's term, it is getting a wrongful gain with a wrongful loss to the other party by way of concealment of facts or otherwise. That's a sort of definition which is more sort of broad-based definition. So if you have to control fraud, as Raviji said, and he laid out some of the pointers on that during his speech, but let me cover some of the other aspects also. So we need to know what is the sort of various angles behind the fraud, and these are called fraud angles. And the three main factors are there: motivation, opportunity, and rationalization. So motivation, Raviji talked about it, the sales incentives or the bonuses, commission, all that kind of stuff. People want to maintain the status. So that will give them the motivation that they should do something wrong to wrongfully gain money. That is one sort of thing. Raviji also talked about the management motivation out of it. There will be a situation where there will be no personal motivation, but it is more business driven. Like you have to maintain the certain analyst expectations or increase in the share price, maintain the share price, or meet the loan covenants and all that. And that will actually force you to undertake these activities. You may not be getting anything in person at your personal benefit, but that might be the case. Second point is regarding personality and temperament. So here, personality wise, if the person has got gambling habits, for example, he's likely to face financial issues, and that will sort of tempt him into getting into fraud, right? We have also heard Raviji talking about management fraud. So this is like the setting the tone at the top. This is the term which we look at it. When the management itself is doing the fraud, then it is very difficult to control such fraud. One such example I would quote is a bank in US, Wachovia Bank, where what happened was the management was forcing the staff to open fictitious accounts to show that there is growth in business. They were forcing the customers to sell the credit cards forcefully to the customers. And as a result, the bank actually faced a huge reputational risk. So the downside of all these motivations is the reputational risk. Finally, the business suffers heavily. And you might have heard about this quote from Warren Buffett. And he said in one of his speeches, it takes he was talking in the 35th year of his company. And he said, it takes 35 years to build a reputation. And it takes only 35 minutes to really destroy, 35 years to build and 35 minutes to destroy. So that kind of a thing can happen when such frauds come to light. Now, what is the opportunity? The way the organizations are structured, systemically or otherwise, there will be opportunities which will be there. So weak internal control system is one major reason which is there. So that will allow the people to do the fraud, or security of the assets is not there. So people will take away the inventory. That could be there. The other thing is that the employees know that there is nothing going to happen. No penalty will be there if they are caught. So lack of fear also will allow them to do it. Unclear policies is one other thing, whether they can approve or not approve. So they will end up in exceeding their authority. And here again, it will turn knowingly to do that kind of fraud, right? The third step in this cycle is the rationalization, right? So people will try to rationalize that they will, this is the way things are done. It happens. Chalta hai attitude is what you will see, that kind of thing, right? People will also saying, yes, I have to do it because it needs to be done. Some people will say that, oh, it's a harmless thing, it's minor thing. If I take some money out of it or some inventory out of it, it is harmless. Business will not be affected. And some people will even try to justify it, right? So we should understand this fraud triangle. So if you understand who is likely to commit fraud, who will have the motivation, where the opportunity for fraud is there, and what kind of rationalization is likely to happen, and then you will be able to control the fraud. So first, it's very important to understand this context so that you attack where it is necessary. The problem with fraud control is that the cost of control sometimes may exceed the level of fraud itself, right? So you have to balance both the things. And in case of fraud, one peculiar problem arises. Like if you investigate 10,000 cases, only one case may be a true positive, whereas the rest of the cases will be false positives. And that results in a huge cost. So you have to find an optimum balance which will give you the maximum result, right? So in US terminology, they call it bang for the buck. So that kind of techniques and tools which we should be using. One other data point for you from the fraud surveys which are there is that the individuals who are committing fraud nowadays are middle-aged men, and typically they don't have a criminal history, and many a times they are the first time sort of fraudsters or first time sort of doing the fraud. So that's a kind of population which we are trying to address over here. Now, if you look at the types of frauds, again, Raviji touched upon it very briefly, but I will try to categorize it into different categories, right? So I will categorize it into 5 different buckets: asset misappropriation, financial statement related, corruption and bribery, technology related, and industry specific frauds which are there, right? So assets misappropriation related frauds, we all know cash theft, which is there, or deposit kiting kind of thing will happen. Fraudulent payments will happen. Scheming, teaming, and lying, that kind of thing will be happening, right? Inventory related, we again know that false purchase recording, false sales recording, inventory theft, wrongful write-offs which are there, using the things for personal benefit, as on fictitious, on plant and machinery type, again, similar things which will happen. One of the biggest sort of asset misappropriation which happens is the intellectual theft, and especially since we are moving into the intellectual economy, the IP is one of the very big asset which is there that carries a lot of value to the business. So this IP theft is also one of the major sort of areas where there could be a theft. So in IT company, we have seen that people are trying to send the documents out, which are like the business secrets or some of the templates or the models which are being used. They are trying to send it outside, right? So that kind of theft is also happening. The second type is financial statement fraud, which again, all of us know very well. Asset or revenue overstatement, understatement, improper classification. There could be timing differences so that you show lesser expenses in the current period. You try to put it as deferred revenue. All these kind of techniques which are being used. On the liability or expense side also, again, similar type of techniques which will be used, right? So financial statement fraud is one of the biggest contributors to the fraud universe, I would say. And two prominent cases are there. One of them, Raviji actually touched upon, is Satyam. The other big one, and that is where I think some of the tightening of the financial reporting started to come in, was the Enron case, where $74 billion the investors lost because that company went down. The management was trying to do fraud using the very complex organization structures and hiding the losses, right? The next one is the corruption. Again, very prominent in economies, developing economies. Not that developed economies don't have it, but in very prominent. The prominent amongst them is the conflict of interest, where you will have the management or the manager having an interest in the particular deal, that kind of a thing, or bribery kind of situation, like bid rigging or accepting kickbacks kind of stuff. In some cases, the benefit which is there could be in non-monetary type also, like a foreign trip kind of a thing, right? It could also go to the extreme extent of exhaustion or of economic, political, or social type of thing which is there, right? Tax fraud or money laundering also people put under this similar category, I would say. Technology fraud, again, information security related fraud, again, is expanding very rapidly because of the advancing of the technology which is there. So you sharing of the password, OTP, CVV sharing, unauthorized access to the systems, identity theft, you will get phishing or wishing emails which is there. You will get email spoofing, where you will find that the email is coming from the reliable source, although it is coming from a fraudster. Account takeover by forcibly logging into your account. All those kind of things will be there. At a more sort of organized level is the cyber crime which is there, or cyber frauds, which are like technology attacks, which are like denial of service. So the company's website will be pulled down, you will not be able to access it, or there will be a spam attack or a virus attack, malware attack, which will be there. So that kind of a thing which will be there to bring down your business, right? And finally, the industry-specific scenario. So, for example, in case of insurance, claims fraud is very, very common. In case of banking and financial services, the credit fraud is very common. So, similar thing will be there in IT industry, healthcare, telecom, retail. So, you will have industry-specific nature which is there. The reason to bring this up is that based on the industry in which you are operating, you will have to find out which are the possible areas where you are likely to hit, and your action should be based on the likelihood, basically. So fraud risk you can measure based on impact and likelihood. Higher the likelihood and the impact, more will be your rigor in your control, right? And you will try to put in controls for the preventive in nature, and you will also spend time on and money on putting a detective control, that if somebody breaks into the preventive control, you will have the early detection of the control, right? And as I said, proportionality principle will apply in this particular situation. So rigor will depend on the impact and the likelihood which is there, right? Maximum sort of frauds which have happened, they are in the misappropriation of the cash flows, that type, or in change in the balance sheet structure, which is more like a financial statement fraud. And of course, the technology related frauds, what we talked about, right? Before I jump into the tools and technology, I would just like to spend a minute on this particular slide. Now, if all of you are chartered accountants, and if I ask you the difference between financial accounting and management accounting, all of you would be able to tell me very, very easily. What I'm trying to depict in this particular slide is to bring out that difference between the two, and which is where our tools and techniques will have to come into picture. Raviji actually touched upon some of the aspects, but I will try to expand on it. So if you look at it, how the whole process happens, so you will have the business activities, which will result in some transactions. These transactions will get recorded, classified, and finally posted to the GL, which will get you the financial accounting, financial statements, which is there, right? The same data you can use for management accounting, but there is a difference between the two. And that's what we should understand very clearly, so that we can use the management tools very, very effectively, right? So if you go open the bonnet, what really is happening is that you will capture the data. That data, you will convert it into a meaningful information. You will try to do that analysis, and that will give you finally the financial reporting. So when you do a financial reporting, you will have the assets and liabilities. If there is a variation, you will do that analysis. You will assure yourself that it is true and fair or not, right? Whereas in case of management accounting, you are not really worried about the true and fair view. What you are trying to find out is how you can improve your business, how it will help you in terms of sound business decisions. And we are also discussing in this session how it will help you in terms of fraud prevention and control, right? So the management accounting really goes beyond just the analysis. What it tries to do is to extract the knowledge out of it, and that knowledge will result in some actionable metrics for you. So just to give you an example, in financial statement, you will find that there is an electricity expense, right? So you will find that, okay, electricity expense is so much, previous year was so much, and this year is so much, not much of variation, you will stop at that, right? But when you come to management accounting, you will try to find out, okay, this much units of energy is consumed at this price, how much was the per unit consumption of electricity to produce 1 unit of output, and whether that unit of output will it get impacted because of the changes in the prices of electricity or not? Can I do something to bring down that particular cost or not? So is solar an option for you or not, right? So you will go beyond the financial statement analysis by getting the additional information and calibration of the financial as well as non-financial information or data or ratios, right? So for example, in case of say particular situation, you are not able to estimate how much is the revenue, right? In management accounting, you will use some proxies which are there to estimate that particular thing. That kind of a thing may not be possible for you to do in the financial statement world which is there, right? So that is what you will have to look at it. So if I have to summarize it, management accounting will go beyond the financial accounting. It will bring in additional information, data, or ratios, which could be financial as well as non-financial. The example what Ravi sir gave was a camera, right? So the the information which will get captured is a non-financial information, right? So who came in at what time, somebody accessed the warehouse, all that kind of information is not part of your financial statements, but it is part of your non-financial information, which is available at your disposal using the technology, and that can help you in terms of preventing the frauds which is there, right? So what you have to do is use these tools and technologies which are there as part of the management accounting, and how we can do that is what I would try to cover in the next few minutes. Any questions so far?
Yes, sir. We have one question. Mr. Sanjeev Kumar ji is asking what kind of preventive step may be taken by the company to prevent the occurrence of fraud.
Okay, so we are going to discuss this, and the 3 types of techniques which I think are applicable. Ravi ji talked about it at high level. I'll try to dig deeper onto that, and we will see whether your question is getting answered or not. So 3 types of techniques I believe are possible. Financial, the data analysis, which is using the technology, and third is the statistical type of techniques which are there, right? So these are the 3 prominent ways in which you can use this management accounting techniques to get the things, right? So the first one is contribution margin analysis. Now, again, being chartered accountants, we know what the contribution margin is. So it's a sales minus the variable cost, right? So the variable cost is expected to remain more or less constant vis-a-vis the units which are there, right? With the sales volume, right? So if there is a wide variation in the contribution margin, that will be your red flag, which will tell you that something might be going wrong, right? If you look at it, fixed costs, they are likely to again remain fixed, and that is the reason. Again, you can look at the fixed costs in detail, and you can see where there is a major variation or not, and you can control based on that. Coming back to contribution margin, that kind of a thing, you will be able to find out whether there is any skimming of sales which is happening, or there is theft of inventory which is happening, right? Because what will happen is that if the skimming of sales is happening, you will have the variable cost which will be there, but the sales will not be there, right? So that way you will be able to determine that yes, the sales are not there, but the variable cost is there, and your contribution margin will be accordingly lower, which is there. This is precisely the thing which happened in a US company called COS. They used to make the speakers and electronic equipment, and almost 30 million loss happened because of this sales skimming, which is there. The other side of it is that if the employees are taking away the inventory, right? So that inventory is going away. You have the expense which is happening, but there is no corresponding sales which is there, right? So that way you will come to know that the sales are not there, but the inventory is increasing, right? So that way you will be able to again figure out whether the inventory is being taken away. That fraud you will be able to identify using the contribution margin analysis which is there, right? You can also drill down this particular contribution margin by product, by region, as such, which is there, right? So material usage variance or sales unit variance, which is there, that kind of a thing also you will be able to get if you dig further deeper into it. So a particular product is showing high growth or high contribution margin. Is it really there, or is it some kind of overstatement which is happening over here? Is again, you will see. Conversely, on the other side, I gave you the example with variable cost being higher than the sales. Converse case also could happen, that you will have higher sales but lower variable cost which is there, because that material is never consumed. You are only booking fictitious sales which is there, right? So that kind of a thing you will be able to find out from the contribution margin type of analysis. Raviji touched about the budgeting aspect, and he said we are not using the budgeting as a tool very, very effectively. I would tend to agree with him, because budget is a sort of indicator as to what is likely to happen in future, what you are trying to achieve based on your market feedback and anticipated future changes which are there, right? And you will do a variance analysis. Now, this variance analysis can give you a different picture, right? Because this variance will have a causal and deterministic relationship between those parameters which are there. Like, so unit sales and revenue, there will be a correlation which is there, right? So you will be able to identify the deviations which are there from this, right? So kickback schemes, especially, you can find out from this type of variance analysis. So purchase price variance could be very high. So you are buying inventory at a much higher price because you are getting a kickback from your suppliers, right? So that kind of a thing you will be able to find out through the variance analysis, price variance which is there. If the employees are taking away, there is a theft which is happening in the warehouse, then material usage variance will show up that picture which is there, right? So what this variance analysis will be able to tell you is that the relationship which you are expecting vis-a-vis the relationship which is there, right? So that will be depicted in this particular case, right? You could also find out a case where the material usage variance is not there, right? So it could be a non-receipt of the merchandise also is there, or a short shipment which is there, or if you are having a high sales which is there. So again, the goods are not being shipped, but they are there. You are booking the fictitious sales which is there, right? So that kind of a thing which you will be able to do through the variance analysis. I also gave you the example of electricity expenses which are there, right? So that kind of analysis, again, you can look at it. There are some expenses which are likely, which are like of fraudulent in nature, right? And coming from my IT company, there is one case which comes to my mind very, very clearly, is that the employees were booking fictitious medical bills which were there, right? And the amount of the medical bills was much higher than in particular months, right? So the analysis showed up that those medical bills were falsified, and the employees were trying to use them to pocket the cash, basically by submitting the fictitious bills, and it resulted in some of the employees also getting fired, because ultimately it is the trust and integrity issue which comes into picture. And in many organizations, trust and integrity is non-negotiable. I told you about the Warren Buffett statement. It takes only 35 minutes to wipe out the reputation which you have earned over long years, right? So that kind of a thing which will happen, right? Ratio analysis, again, all of us know all the ratio analysis, various types of ratios which are there. So again, what are the ratios? The ratios are the relationship between the two variables which are there, right? And coming from banking industry, if you read any news about the frauds which are there, and you will find that there is a anti-money, the money laundering and the fund diversion angle to it. So the borrowers have taken the money from the financial institutions, and they have diverted the money. Now, where do this thing get reflected? It will get reflected in form of, say, loans and advances to subsidiary or investments in subsidiaries. So when you compare these figures which are there, that will give you an indication whether these figures are genuine or not, or whether these are these figures for looking fraudulent in nature, right? So that kind of a thing which is there, right? Anirudh Ji talked about the borrowers falsifying the accounts, right? So this is again a sort of thing which is there to get higher limits from the banks. What they will try to do is that they will show higher amount of inventory and higher amount of stock and book dates which are there, right? So that will help them in terms of getting the required limits from the bank. But if you look at it from the other angle, if you have got such a high inventory or such a high debtors turnover ratio, then that turnover ratio will tell you that the debtors are exceptionally high, right? So that will tell you that something is going wrong over here. There might be something wrong happening over here. Same case with the inventory turnover ratio, which is there, right? So that kind of a thing, which will if you are able to correlate the financial statements and the various ratios which are there, you will be able to find out whether the financial accounts are falsified or not, right? There are some models which are being built, and I have one of the model as part of the presentation, which is called the Binish Model. So what it does is that it takes the various elements of the financial statements and it has attached a certain factors to it. And what it computes is the M score. So what it tells you, M score actually tells you the reliability of the financial statements. That is one of the things which you can, such type of models you will be able to do, or there are some industry standard models, like I told you, this Binish model, which is there. So this kind of a thing, you will be able to do it using this ratio analysis, which is there. Next one is the key risk indicator. Now, key risk indicator, as the name suggests, it is the indicator of the risk of what is likely to happen in future, or what is it, where the institution is headed, and is it facing some risk or not, right? So some of the indicators which are typically used, I have tried to summarize them into this particular slide. These are common across the board. So revenue related, for example, it is abnormal increase in sales in quantity or amount. And some examples Raviji gave, like in if there is an abnormal increase of winter clothing in the month of May, that could be an indicator for you that something is really going wrong over here, right? Or the trend analysis, if you do, you find that, okay, the normal increase in sales is between 2 to 3%, and suddenly you see 20% increase in sales. In quantity or in price, you have to be really awake to find out what really is happening over here, right? The other areas where the frauds could happen is form of sales returns, right? So typically what will happen is that at the quarter end, you will try to book the inventory, or at the year end, you will try to book the sales to show higher sales amount, try to get the personal benefits, and the next period you will see that those goods are being returned, right? So that kind of a thing. So if there are abnormal increase in the sales returns during the period, or are there or not. Debtors turnover, I gave you the example in case of lenders. When they do the analysis, they have to look at the amount of the inventory as well as the debtors turnover ratio, which is there, right? Similar thing you can do on the purchases side, where the quantity and the amount variance, how much is the usage normally, how much is being used, how much is the usage vis-a-vis the production amount. So for example, you have used 10 tons of material, and normally in 10 tons of material, you are getting 1 lakh units. Now in 10 tons of material, if you are getting only 50,000 units, then there is something wrong in it, right? So that kind of a thing you will try to find out. If there are any purchase orders which are created and approved by one person only or not, right? Is there any difference between the number of purchase orders and after the supplier invoice date? That kind of analysis also you will be able to do, because you are now doing most of the accounting is happening through the system. So you can run various reports, right? Which are the supplier's invoice which are approved by a particular manager only, right? So if a particular supplier's invoice are approved by only one particular manager, right? So there could be a connivance between the two parties. It's not a foolproof sort of conclusion that yes, there is a fraud, but there is an indication. It gives you an indicator that there could be something wrong which might be happening, right? Inventory, again, we talked about it, right? Supplier payments, receivable, cash, again, you can look at it. Journal entries is again one other area where frauds could happen, because one entry you can pass and you can convert a profit into a loss, or a loss into a profit, right? So that kind of a thing you will be able to do. One other area in financial statement related fraud, which all of us possibly would know, is that wherever an estimation is involved, those figures are likely or they are prone to fraud. And we have to be exceptionally careful about those figures. How much is the usage variance, how much is the scrap which is getting generated, how much is the loss which is there. Like in oil and gas, for example, the amount of loss which is there due to evaporation or the normal loss which is there as part of the industry practice, right? If there is a variation in that, that could also tell you that something could be going wrong. So these are some of the financial techniques which you can utilize to find out what are the things which can be found out by using this information which is available in the books of accounts. The financial statements you will prepare for your true and fair view, but you go beyond those financial statements, use that information, further drill down, do an additional analysis, and it may give you some insights where the likely frauds are happening. Right? It is not a case that yes, the fraud is happening, but it will tell you an indicator where the fraud is likely to happen, or is it happening or not, like the cost case which I talked about, right? So that is the kind of tools and techniques as far as the financial statement is concerned. The next in the line is the data analysis techniques, and this is sort of facilitated by the technology which is available at our disposal, right? With the availability of technology, there is availability of abundant amount of data which is available, but two challenges are there relating to the data, right? But the data which is there is spread across multiple data sources. So that is one biggest challenge which is there, right? So the data in system A may not reconcile to data in system B, right? So that is where the challenge here becomes, right? So assume that you have even tackled that particular challenge, right? So you have the data which is sort of unified data. For the sake of simplicity, I would say unified as a simplistic word, right? But that data which is available, you should know what is the relevance of that data. So many a times the data which is available does not have the relevance or the clarity, or in some cases even the accuracy is not there. So in many cases, this data quality issue also is one of the biggest challenges which you will find if you are doing the data analysis. And when we do data related projects and we try to do analysis, we find that in many places where there should be a number which should be there, there could be some alphabets which might be there, or a garbage data will be there, right? So it often what it results in the data rich but information poor kind of situation, right? So you have got abundant amount of data, but data is there, but you are not able to properly assess or analyze the data. Assume that you have tackled these challenges of relevance and quality and all that. Many cases the organization have been able to do by bringing in discipline in the whole processes. But what do you do with the data? Because it's a massive amount of data which is available. And if you sit down and manually try to do that analysis, it is not useful. It is not efficient, right? So that is where the data mining tools come handy. And this data mining tools is nothing but collection of techniques and algorithm which will help you identify the patterns which are there in the concealed in the underlying that data. So data mining will help you identify the patterns which are there. The pattern it will be able to identify, but that intelligence behind it, I use the term knowledge extraction. That knowledge you will have to extract out of those patterns, with which you can create the actionable metrics which is there, right? So that is what you will have to do. Now, two types of data analysis is possible. One is called the descriptive and the other one is called the predictive, right? So what do we mean by the two terms? The descriptive data analysis is talking about the general attributes of the data. Like, so for example, where are the customers located? Are they sole proprietor, or are they SMEs, or are they large corporates? These kind of information you will be able to get by analyzing the data, which is more descriptive in nature, and you can create the charts or graphs or any pie charts and all those kind of things using the descriptive type of data analysis. The other type of data analysis you can do is called the predictive analysis, right? So predictive analysis, what we are talking about is to look at that data and try to predict, right? So this is where a lot of energy is going in terms of finding out, based on the data, who are the customers who are likely to defraud, right? So artificial intelligence and machine learning, these are the techniques which have come into play in recent times, which will help you analyze that data and will be able to get you that kind of information by which you can predict, like who are the customers who are likely to sort of defraud, right? So based on your customer characteristics, your transaction characteristics, your behavioral pattern, which is there, you will be able to find out who is likely to defraud, right? So this banking industry extensively uses this techniques for money laundering or fraud management activities, right? So that is there. One other challenge which is there relating to data is the type of data, right? Traditionally, all the accounting systems which we have got nowadays, they are all based on the relational databases, right? So this data is available in the structured fashion in terms of the rows and tables and columns which are there, right? But there is a huge amount of unstructured data which is also now available, and that is very useful in identifying the fraud. And for example, you have got a lot of information which is available on Facebook or on Instagram and all these social media tools which are there, right? Or in many cases, there could be an exchange which is happening through emails which are there, right? So these are called unstructured data, and lot of information which is available, which is there, which can be, which is sort of available, which can give you an insight in terms of the fraudulent activities of the customers or potential fraudsters which are there, right? So financial institutions are actually combining the traditional information sources which are there, the relational databases or the normal database information, with this unstructured data. And the new technology which has come into place, which is called big data, is helping in terms of getting that information, right? So for example, if you are lending today to a particular customer, the bank is actually trying to go look at all the sources of information which is there, right? So the information will be available in the GST network, it will be available in the IT portal, it will be available with the account aggregators which are there. They can also look at his social media site, they can also look at credit bureaus and all that, right? Now that all this information which is there, which is more unstructured in nature, you can get that information and then you can possibly put it in a structured or unstructured fashion, whichever way you want it, right? So that is the sort of benefit which is available today now, like the big data and artificial intelligence and machine learning, which will be able to get you that information or the patterns or the meaningful analysis out of that thing. Right now, such a thing is not visible to a manual eye, right? So aggregation of data or various techniques which are there over the structured or unstructured data, which are not available, right? Nowadays, there is a text analytics is also available, right? So based on the text which is appearing, you will be able to find out. So there are news portals which are available, which will tell you that so-and-so company has got a case where the ED is investigating them, or there is a fraud which is registered against them, or there is a police complaint which is registered against the promoters which is there, right? So that kind of a thing which is available, right? So you can use the data from the social networking websites, other alternate information sources which are there, right? So that kind of a patterns you will be able to create out of those data which is there. and you will be able to identify that data, right? You will be able to use that data. From that data, you will be able to find out the inconsistencies also which are there, and you will be able to make a meaningful analysis out of it. So 3 major techniques which are there, which are used in this particular case. The first one is called the association analysis. Now, association analysis, as the name suggests, it is the trying to find out the association between the two data elements or within the information sets which are there, right? So association analysis is typically used in the marketing world, right? So they use this technique to find out which are the 2 products which are likely should be kept together so that they are sold very, very quickly, right? So you will find in a hardware store, the nail and the hammer will be kept together, right? So that kind of a thing is used in the marketing jargon. But that same techniques you can use for the associations which are there in the financial and the non-financial data, the unstructured data, which is there, right? So you can find out if a particular supplier's invoice are approved only by a particular supplier, or a particular customer only, or a particular employee leaves late and he's the last one to leave, so he will have the potential to take away the inventory or not, right? So that kind of a thing, you will be able to use these 2 elements to find out whether there is a potential fraud opportunity or not, right? So that is what you can do with the association analysis. The second technique which is typically used is called the cluster analysis. And what do we mean by cluster is that based on this humongous amount of data, you will try to put them in a manageable data sets which are there, which are homogeneous in nature, right? So all the data elements in a data cluster will be homogeneous, right? But 2 data clusters will be heterogeneous. That is, they will not be similar, right? So the cluster analysis, what it will help you do is that you will try to group the customers into homogeneous units. And if you create one data set of customers, that data set will be completely different from the second data sets. And you can then do different types of analysis on 2 different data sets, and you will be able to get a meaningful analysis out of it, right? So there are tools and techniques, the tools which are available, like SPSS is one such tool which is available. There are other tools available in the market. So if you input the data, it will be able to create the sort of cluster analysis out of the data which is there and create a homogeneous data set, which is a cluster, and heterogeneity between the clusters which is there, right? So one good thing in the cluster analysis is that it does not assume any kind of statistical distribution, or statistical assumptions are not there behind it. So it is only looking at the homogeneity of the data, and based on that data, it is trying to do the cluster analysis, right? And you can run all the various normal arithmetical functions or even the statistical functions on top of it to find out what the sort of meaningful information out of it. And one such example I would give is that one of the insurance company actually ran a cluster analysis on the 40,000 odd claims which they had, right? And they analyzed what are the attributes of these claims which were there, right? And who are the customers, what type of claim, what is the amount, when it was submitted, what was the time taken to settle that claim, all that kind of data elements they analyzed in detail, created the clusters, right? And based on this large data set, when they did the cluster analysis and when they did the techniques, various statistical techniques which I mentioned, what they found out is that 3 characteristics which are there where the fraud is most prominent or is likely to happen, right? So they found out that if there is a long time gap between the submission of the document and claim payment, right? So that is a potential case where the fraud is likely to happen, right? Or there is a payment which is there, it's beyond a certain threshold which is there, right? So that is the case where the fraud is likely to happen, right? Or there are payments which are delayed and there is some institution has to make some interest payments on it, or delayed interest payments on it. So that kind of a thing was done intentionally, and they were able to find out a fraud which was there, right? So cluster analysis, again, if you are able to do that analysis, you will be able to get the information out of it. And as I gave you the information of the insurance industry, they were able to pinpoint that 3 data elements which are very, very critical, and they should look at it very, very carefully. And if they are able to monitor that, you can put a monitoring mechanism that the time between the submission of the claim and settlement of claim is beyond X days, give me a report, right? So that will be a smaller set which you will have to look at out of this 40,000 which is claims which are there. So if you are asked that, okay, go through this 40,000 claims and tell me which are the claims I should look at in detail, it will be very tough to do that. But through this analysis, you will be able to create a smaller sample on which you can put a focused effort. Now, the same cluster analysis you can do on the cost elements, also on variable cost, on the fixed cost basis items which are there. You can create clusters and you can do that type of analysis also at the transaction level, right? So that's the second technique. The third technique is called the outlier analysis. Now, what do we mean by outlier analysis? Is that the data element which is there that does not conform to the standard behavior pattern which is expected, right? So that is an outlier which is there, right? So this is very, very important from the fraud detection perspective, and you can use various statistical techniques also, like mean, standard deviation, which are there, some value which is more than a certain number of standard deviations is a likely outlier, and that could be a potential case of a fraud which is there, right? So that kind of outlier analysis you will be able to do using these statistical techniques. I'll give you one example where this is being very, very prominently used, and you also might have experienced it in your day-to-day life, right? Credit card companies use this very, very extensively. Like, for example, I am based in India and I normally spend 10,000 rupees on my card, right? So if a particular thing, say vendor, I mean like a merchant transaction is done in US, for example, then you will be able to clearly say that I don't travel abroad. All my transactions are always in India. How come suddenly there is a transaction which is happening in Walmart in US, right? And typically the fraudsters also do a typical sort of transaction. What they will do is they will first do a small transaction, $10, $20, $30 transaction. If it goes through, then they get confident that they will be able to do a larger value transaction, buy an Apple phone using that, right? So that kind of a thing, they are able to detect that this is an outlier transaction. So you might immediately get a call from the credit card company saying that, did you do this particular transaction, right? Or it might happen that you are normally spending 10,000 rupees on your card, and suddenly you see 50,000 rupees transaction which is coming in a jeweler shop from you. You have never purchased jewelry in last 3 years, right? You have never spent any money on jewelry, and suddenly there is an expense, right? So that gives them a sort of warning signal that this could be a potential fraud, right? So that's how at the transaction level, they are able to control it. In a real life situation, the frauds which are happening, and this is the question which was asked, how do we prevent fraud? So the frauds can be prevented by putting the controls which are there. So preventive controls and the detective controls, you will put it. Some of them will happen at the transaction level. Some of them happen at the periodic interval level, like at the month end, at the quarter end, that kind of a thing. Sometimes it will happen at the analytical reviews, the management reviews, which are happening at the periodic levels which are there. And that is the first line of defense which you have got. So preventive control are the best controls. But again, you have to weigh the cost of control and the benefit of that particular control which is there. If the fraud amount is going to be, say, only 10,000 rupees and putting the camera is going to cost me 50,000 rupees, do I really put that camera? That decision will have to be made. Now, in some cases, the organizations may say that, okay, I may still put that camera because it justifies, it puts in as a preventive check. The employees know now that they are being observed and they can't take away the inventory, right? So today the loss might be 10,000, but as you grow, it might turn into 5 lakhs, and that 50,000 investment will justify the investment which is there, right? So that kind of management brain has to go, that knowledgeable knowledge extraction has to happen out of that information, with which you can take the actionable matrix which is there. The third category of technique which is there is called the statistical technique, which is regression is typically being used. We all know the regression thing, and the Binish model which I talked about, it is using the regression technique which is there, and based on which there is a formula which they have devised, that based on that formula they will try to find out the reliability of the financial statements, right? So that is how they have tried to do it. It is based on the analysis of the financial statement, the past experience, what kind of frauds were happened, what kind of ratios were there in that financial statements. They have done that kind of analysis, and based on that, which is there. So we will. I'll spend some more time on giving specific examples from the banking industry, how they have used that particular, these techniques, what we talked about, and what kind of controls which they have put in there. To summarize on this particular slide, this is some of the ways and means which are available at the fingertips of all of us to use. And I mean, like I would say, as a chartered accountant, there is a great opportunity for us, a business opportunity for us, because we know the data, we know the financial statement, we know the fraud, right? So if we have the slight technical capability which is there of this analysis, or even if we don't have the analysis, there are technical people who will be able to run the analysis for you. But making the sense out of the data, what kind of data you should use, what kind of techniques you should use, what is the interpretation of the results which are coming in. Here lies the value of chartered accountants like us, because we know all the connected, we can connect all the dots, right? We know the financial statements, we know the fraud, we know how the things happen, we know the process, we know controls, we know where the controls can fail. We know what kind of loss which can occur, and we will be able to make the sense out of the data. Large amount of data is there, and I would use one term which we should keep in mind, that we don't want to go with a traditional way. What we want is a risk intelligent organization or a risk intelligent practitioner, right? So if you are working in an organization, the organization should understand the risk and have the intelligence around that risk, so that it can take a meaningful decision around that risk which is there. If you are a practitioner, a risk intelligent decision making is where you can help the organizations in terms of reducing the frauds which are there, right? So what I will do is that I will spend, in the interest of time, I'll spend few more minutes so that we have time for our discussion on question and answers here. Any questions so far before I talk about this, how the banking industry uses these techniques?
Yes, sir, there are a few questions. So,
Okay.
Mr. Ravi Chandran has asked that any control required for the charitable organization?
Any organization which is getting money and spending money, definitely a control is required. That is as far as the financial aspect is concerned. Of course, there will be regulatory charity commissioner rules and all those things will be there. And all those things also will constitute a fraud. You don't follow the things, you enter into activities which are not permitted, you spend on the activities which are not permitted. All those things also, if you take a wider definition, it is also constituting a fraud. So in my view, wherever the money or the assets I mean, like physical or intellectual or that kind of stuff, which are there, you will have to put in the controls so that there is no frauds which are happening.
Okay. And Mr. Ramji is asking that is there any correlation between GST input tax credit lying in the books versus inventory depicted in the balance sheet? In other words, if we say, could this be treated as tool for detection of fraud?
Yeah, potentially you can say yes, but it all depends on what happens to that inventory, right? You will take that GST input credit. If it converts into your sales, you will be utilizing that, right? So if the sales have not happened, then it will still remain in your inventory. So either side, you should be able to verify. It is not a firm case that yes, it's a fraud, but it's an indicator. Now, financial institutions are actually correlating your GST figures with what you are reporting in the financial statement. So that tells them that yes, if you are saying your turnover is 100 crore, are you really reporting that 100 crore in GST or not? So if there is a variation, that could come out. If there is a variation even in the GST figure and the financial statement figure in some of the cases which we have observed, and we have to go back to the borrowers and ask them that why there is a variation, right? So I would say, if I use the common sense on this, I'm not a champion on GST, but my understanding is that you will utilize this input credit when you actually sell the goods and you pay the GST, right? So that correlation is there, but that correlation is not, I would say, confirmed. You will have to dig deeper and see whether there is really a fraud or not. It's not a confirmed case of fraud.
Yeah, that's it, sir. We don't have any further questions.
Yeah.
So you can continue with your deliberation.
Okay. So what I will try to do is that I will try to cover the whatever I talked about in this particular slide with a banking industry example. And why it is very important for banking industry is that RBI publishes the fraud figures for the financial institutions, whatever are reported by the financial institutions. There is a need to report all these losses, right? Fraud losses. So the amount of the loss, when I last checked, was more than 1 lakh crores, 1,09,000 to be precise. And 80% of them, almost 80,000 crores, was credit related fraud. The next category of loss which was there was the cyber loss, basically information security and cyber related incident. The amount was small, but the number was very large, right? Because lots of small cases were reported. But the big chunk was the credit related frauds. And there is a huge focus amongst the RBI as well as the financial institutions on getting this right so that they don't have the situation of credit frauds, right? So the first stage in the life cycle is the credit appraisal and the financial statement analysis is when you are lending the money is going out of the door of the bank, right? So you have to be extremely careful at that. And this is the particular point where lots of frauds have happened. So you have to put in a lot of controls and the checks which are there. And the ratio analysis and the trend analysis, what we talked about, is very, very relevant here. Also, the other in alternate data sources, which I talked about, they also become very, very relevant over here, right? So typically the financial institution will use the debt equity ratio, interest service coverage ratio, EBITDA, turnover ratio, collateral coverage ratio, loan to value ratio, etc. Right? So financial institutions as a standard will have certain benchmark values which are there, right? So debt equity ratio should be so much, or a loan to value ratio should be so much, right? So two things can happen based on this, right? So the bank first to fix these ratios, number one. Number two is to run a report where you can see that which are the cases where the loan to value ratio is lower than your benchmark, or a debt equity ratio is lower than your benchmark, right? And the next thing to look at is that are those cases approved as per the authority matrix or not? Are these properly approved? They are properly analyzed, investigated, analyzed, and discussed, and then only approved, or the authority matrix has been violated, right? If the authority matrix is violated, it itself is a first case of fraud which is there. The second case of fraud is in this particular case is that you have the loan to value ratio which is lower, right? So that means that if by misfortune you have really, the money has gone out of the door and the loan to value ratio is lower, right? So in that case, you know, or you get an early warning. You are risk intelligent that in this particular 15 cases, the loan to value is lower, and I have to closely monitor these particular cases, that there could be frauds in this particular case. There may not be any fraud in these cases also. That's also a possibility, but it gives you a risk intelligent view that you should monitor them which are there, right? So if there are, you can also run a query to find out, you can run a report to find out how many number of deviations which are there, right? So normally the deviation by definition should be an abnormal event. It should not be a normal event, right? So if you have processed 1 lakh applications and 99,000 cases you have got deviations, that means something is terribly wrong in your process. You are likely to hit, and the organization's existence itself might be at risk, right? Reputation risk is there, and the existential risk is also there, right? So they will be putting lot of things, controls around that, right? The other area in this particular case you will observe is the manipulation of the financial statements by the borrowers itself, right? So what you can do is that, in case, again, you will use the ratio analysis. You will also try to benchmark yourself with the peers which are there, right? So particular company, if you are looking at, say, a company which is in FMCG, right? And FMCG companies are growing at 10%. And if this company shows 40% increase, that should raise an alarm with you that something is wrong. You have to dig deeper into it, right? A particular industry where the gross margin is, say, 5%, but you see a margin which is there, which is in 20%, right? It should raise antennas for you that something may be wrong over here. You can also correlate the information. As I was talking, they may inflate the inventory and the sales, right? Inventory and the stock and good debts which are there, right, to get the limits, right? But it will reflect in your inventory turnover ratio or the debtors turnover ratio. Now, for an industry, you know that the debtors get 60 days credit, and you see 180 days debtors are lying in the books, then that means tells you that there is something going wrong over here, right? The example I gave you for investments in the subsidiaries and associate companies, or loans to and advances to the associate companies which are there, right? So you can do a correlation analysis over here, association analysis over here, peer analysis, the trend analysis. You can use all these techniques. You can also find out the outlier kind of thing, that, okay, this particular item which is there in the financial statement is not in line with what we see normally in that particular industry, right? So all those things you can also be able to do using this type of analysis which is there. So credit appraisal and stage, the financial institutions are using all the techniques what I talked about, the financial and the data analysis. Also, they are also now incorporating the other alternate data sources, the GST data, the income tax data, the credit bureau data, this the director's personal data, central fraud registry, which is maintained by the RBI. So all those areas, all those places you will try to do. You will look at the negative news which is there. You will look at the social profile which is there. You will look at the comments which are there on the company's website which is there, right? The Twitter handles, the Instagram handles and all that. If the customer is having huge amount of customer complaints which is there, right? So that also is an indicator that the customer is facing challenges, and he may be showing a great sales for you, but he's having trouble and that figures may not be genuine, right? So you will combine these alternate data sources which is there. Artificial intelligence is being used in a very big way in terms of this type of analysis which is happening. Predictive analytics is what again very prominently used in this particular case, right? Credit rating and models, again, I gave you the example of Binish model of the reliability of the financial information. There is another model which is used by the financial institutions very prominently, which is called the Altman's Z-score. This is again, there is a slide on that in the slide deck where I've given the actual formula. So this is again a combination of factors which are there from the financial statements, and they have ran a regression analysis on a large data set of companies, which are good companies and the bad companies, and they have tried to find out what is the probability of a particular company defaulting, right? And there are rating agencies which have also created the default models which are there, like if you are giving a loan to a particular customer who is likely to default and all that, right? So that kind of a thing also has been used. The third place, now you are given the loan, you are done used all the models, the money has gone out of the door. Next activity is to keep on monitoring those activities, and here again the management accounting can play a big role, right? So what happens is that there are various monitoring mechanisms which are there, right? So lenders have to give the stock and book date statements. There will be a stock audit which will be done. There might be a credit audit done by the financial institutions, the internal auditors or the external auditors on the credit files which are there, right? So all these things are checks and balances which are being used by the financial institutions to protect themselves, right? So here again, for example, you may find that if the company has defrauded, rather given you the inflated financial statements, right? So they will try to avoid the stock audit, right? So there will be large cases where the stock audit will be delayed, right? So that will be your first indicator that there could be a possibility that there is a fraud lurking around the corner, right? Or if you do the stock and book date statement analysis, right, month on month, you do a trend analysis, you find that there is no movement of inventory, but the sales figures are increasing, right? You do correlation, you find that these figures, there is something fishy going on over here, right? Or the inventory which is normally kept at say 1 crore level, it has suddenly gone to 10 crore, right? So why it has gone suddenly? I mean, you will sort an explanation. It is not confirmed fraud, but it's an indicator of the fraud, which will tell you that yes, there is a fraud which might be happening, right? The Reserve Bank of India and the financial institutions also have instituted early warning signals. So these are the signals that the customer is likely to default, possibly default in the near future, right? So some of those indicators which are there, they are also useful as a fraud indicator which are there. So I gave you that example of the stock and book date statements which are there. So if the financial statements quarterly results show that the sales is dipping, or but still the profits are increasing, right? So that is an indicator for you that there is something wrong which might be happening. So all that kind of stuff which is there. The other type of activity which is coming through the transaction numbers or the amounts which are there, the amount of transactions which are processed by the borrowers, right? So if the money is going to associated companies, your antenna should be up, right? So that kind of a thing, you will be able to look through the transactions, the volume of transactions, the value of transactions. You know that the company's turnover is 100 crore, but the credit in the bank account which is there with you is only 5 crores. Then where is this 95 crores going? That should be an early warning signal for you that there's something wrong which is happening out here, right? So transaction data also will be able to give you that meaningful and risk intelligent information which is there. And last but not the least is the customer, product, region, or staff profitability type of analysis. And here I will give you one example of the public sector bank. Now, this bank opened a branch in New Delhi. It was a very new branch, right? And suddenly what happened was within 1 year, there was a huge amount of Forex transactions which happened through this particular branch. And what was happening was that there were fictitious accounts which were opened in the branch and through which money was transmitted abroad as an import advance. Now, if you send the money abroad to fictitious parties, this money is never going to come out. And that is how that fraud happened. It ran into thousands of crores, actually 6,000 crores to be precise. So that kind of a thing was there. Now, if the financial institution had a control in place where they would analyze the number of transactions, they would analyze the value of the transactions. They are looking at a new branch which is doing such an exceptional amount of transactions, it should have raised an antenna that how is it happening that large amount of money is going abroad. The branch is recent and it is beating the existing branches hands down. So what are they doing, right? So that kind of a thing which is there. One point, especially in COVID times, which is there, that is where when the economy goes down, right, the likelihood of the fraud increases. And this is across the board. Whichever industry you take, you will find that the fraud levels will go up because the economic activity goes down and gainful employment opportunities are not there. So people will resort to fraud. There are motivations, which could be personal gain, could be organizational gain, could be pure sort of personal need, which will be there. That will drive them. And if your controls are weak, they will really exploit it. And such a situation, the catastrophic situations are the greenfield opportunity for the things, right? So that is how the whole thing you can use. I gave you the example of banking industry, but the same principles can be used across the other industries also. There will be industry specific nuances which are there, which you will have to apply. Before I conclude, just the last 2 minutes I will take is that the one other factor which all of us should be aware is that previously our composition of our GDP and the economy was manufacturing was 70%, services was 30%. Now the things are changing the reverse way. It is the manufacturing is reducing and service industry is increasing, right? So we will need the new indicators, new ratios, new industry specific analysis information which is there. Again, with our experience, I say we could add a lot of value to it. One other thing which is there is that, and this has especially happened in case of IT and cyber frauds, is that the financial institutions are putting a lot of controls. The other organizations are also putting a lot of controls, but the fraudsters are also moving aggressively in adopting new techniques. So you will find card skimming kind of a thing happening. Few days back, I was talking where impersonation fraud was there, where somebody actually sent a WhatsApp message pretending to be coming from the CEO of the bank, right, and asking to transfer some money. In other case, in a public sector bank, this happened really, where the fraudster impersonated that the chairman of the bank is speaking, and he said that certain money has to be given to a party and you pay the money, right? So that kind of impersonation fraud, new techniques are coming. So we will have to be proactive in understanding how the fraudsters are moving. We can try to catch up. We can master one step, be ahead of the fraudster. But if not, we should be able to at least understand where they are heading so that we can also put in appropriate controls. And last but not the least, technology is enabler in this whole process. And we have to use these techniques which are coming in, like artificial intelligence, machine learning. We have to use these techniques like data analysis. And with our expertise across the board, in financial statement, in processes, in controls, in frauds, we will be able to get maximum sort of value to our customers or the places where we work if we are able to connect these dots which are there. So with that, I will stop. We have got some time left for any questions we may have. Thank you very much.
Thank you so much, Pradeep Ji. It was a very detailed presentation and very beautiful. Very beautifully you have presented each and every thing with respect to the fraud on various industry, and the case study which you have presented is really amazing because you have covered your theory content in the practical aspect as you have shared the case study. So thank you so much for sharing a great knowledge with us and with our participants. So team, can you just check, do we have Yogesh Agarwal ji or chairman sir from the Aurangabad branch for the vote of thanks? Yogesh Agarwal ji, can you hear me? With respect to question and answer, sir, I have read most of the question which participants had asked. And one question which is left is in case of software company or the IT company, whether forensic audit is mandatory or not, or how it is useful.
So to answer the question, in my knowledge of working in IT industry, forensic audit is not mandatory. But I may be wrong. I can check and revert, but I have not come across any requirement as such. Forensic audit is typically used where they see a potential fraud and they would like to dig deeper and use the techniques. So some of the techniques which I talked about, the data techniques and all that, the forensic auditors use very extensively. And in fact, they use some of the advanced tools and technologies also which are there. So you can look at the emails, or you can look at the information which is there in various systems. You can go into the hidden areas within the systems also to find out where that information is stored, and you can connect the dots. But I don't think there is a mandatory requirement of a forensic audit.
Okay. So I think we don't have any further question. We have covered all the questions being asked by the participants. So with these words, thank you so much, sir, for sharing your great experience with us. And on behalf of Committee on Management Accounting and all the participants, our chairman, Sri Charanjot Singh Nandaji, we are thankful to you for sparing your valuable time with us and sharing your great knowledge and experience with all the participants through your case study, presentation, and address. So we are really grateful to you, sir. Thank you so much.
Thank you. Thank you everyone for giving me this opportunity and your patience in listening to this talk. Thank you very much again to the committee. Thank you.